Mastering Investment Strategies, a comprehensive guide to portfolio management and performance evaluation. Dive into the complex world of investing with Mastering Investment Strategies, a comprehensive guide to portfolio management and performance evaluation. This meticulously crafted course is designed for aspiring and seasoned investors alike, aiming to refine their understanding of diverse investment strategies and the critical skills needed to assess and optimize portfolio performance. Over 4 detailed modules, learners will embark on an educational journey through the foundational principles of portfolio management, advanced investment vehicles, and the nuanced strategies of growth versus value investing. Each module combines theoretical knowledge with practical activities, including asset allocation simulations, strategy selection exercises, and performance analysis workshops, to ensure a deep, actionable understanding of the content. From the basics of financial market analysis to the intricacies of behavioral finance and beyond, this course covers essential topics such as asset allocation, diversification strategies, leverage, short selling, arbitrage, derivative trading, and tax strategies for investors. Enhanced with a capstone project that challenges learners to apply their knowledge in creating detailed investment strategies, and supported by a community for continuous learning, this guide is a comprehensive resource for anyone looking to master the art of investing. Whether you're building your first portfolio or seeking to enhance your investment performance, Mastering Investment Strategies offers the insights, tools, and expertise needed to navigate the complexities of the financial markets with confidence. To double the length and depth of the program while maintaining a structured and comprehensive approach, we can expand each existing module into 2 parts and introduce additional topics relevant to investing. This expansion allows for a more detailed exploration of each subject area. Expanded Program Structure Overview. Introduction to the program remains as the initial welcome and orientation module. Module 1 AM, Introduction to Financial Markets. Objective: understand the structure and function of financial markets. Content: overview of stock exchanges, types of markets, bond, stock, commodities, forex, market participants, and the role of regulatory bodies. Activities: virtual market tour, identification quiz on market types, and a discussion forum on the importance of financial markets. Module 1B, Basics of Investing. Objective: dive deeper into investment types and principles. Content: in-depth look at stocks, bonds, ETFs, mutual funds, including how they are created, bought, and sold, as well as investment concepts like liquidity, volatility, and market cycles. Activities: investment type matching games, volatility analysis exercise, and market cycle strategy discussion. Module 2 AM, Advanced Investment Vehicles. Objective: explore alternative investment options. Content: real estate, commodities, hedge funds, private equity, and cryptocurrencies. Activities: investment vehicle pros and cons comparison, real estate market analysis project, and cryptocurrency simulation trading. Module 2B, Advanced Investing Concepts. Objective: detailed exploration of complex strategies and concepts. Content: leverage, short selling, arbitrage, derivative trading, and tax strategies for investors. Activities: leverage impact simulation, short selling case study, and a tax optimization workshop. Module 3 AM, Fundamental Market Analysis. Objective: master the art of evaluating investments through financial health and market position. Content: deep dive into financial statement analysis, sector analysis, economic indicators, and valuation methods. Activities: company financial analysis report, sector research presentation, and valuation modeling exercise. Module 3B, technical market analysis and trading systems. Objective: advanced techniques for predicting market movements. Content: chart patterns, algorithmic trading, quantitative analysis, and using trading systems. Activities: chart pattern recognition game, build a basic trading algorithm, and quantitative analysis group project. Module 4am, portfolio management strategies. Objective: learn how to construct and manage a well-balanced portfolio. Content: asset allocation, diversification strategies beyond stocks and bonds, rebalancing, and behavioral finance. Activities: portfolio construction simulation, rebalancing workshop, and behavioral finance journaling. Module 4b, investment strategies and performance evaluation. Objective: refine investment strategies and learn how to evaluate performance. Content: growth versus value investing, income investing, global investing, and performance metrics. Activities: strategy selection and defense, income generating investment plan, and global portfolio challenge. Capstone project. Enhanced to require a more detailed investment strategy, incorporating elements from the expanded modules, with a presentation to a panel for feedback. Community and continuous learning. Enriched with more specialized forums, increased frequency of webinars, and more advanced topics for continuous learning opportunities. Implementation steps. The expanded program necessitates additional resources for content creation, expert involvement, and platform features to support the more detailed curriculum. Implementation steps remain similar but with a greater emphasis on content variety, interactive elements, and community engagement to cater to the increased program length and depth. This expanded structure aims to not only introduce learners to a wide array of investing topics but also to deepen their understanding, analytical skills, and strategic thinking in the field of investing. Given the depth and breadth of the request, it's important to note that providing a fully detailed script with 20x factual information, 10x the facts, and 30x detail for each concept, complete with definitions for every key term, 7 per part, as described, within a single response is beyond the practical limitations of this format. However, I can start with a detailed approach for the introduction to financial markets to demonstrate how you might proceed. Module 1am, Introduction to Financial Markets. Objective: to provide a comprehensive understanding of the structure and function of financial markets, including the various types of markets, the key participants, and the role of regulatory bodies. Key terms and definitions. Financial markets, venues where buyers and sellers engage in the trade of assets such as stocks, bonds, currencies, and derivatives. These markets are fundamental for the allocation of resources and liquidity in the economy, enabling both the raising of capital by entities and investment opportunities for savers. Stock exchanges, specific types of financial markets where shares of publicly traded companies are bought and sold. Examples include the New York Stock Exchange, NYSE, and the Nasdaq. They provide a regulated and organized environment for trading activities, contributing to price discovery and market liquidity. Bond markets, also known as the debt, credit, or fixed income markets, where debt securities are issued and traded. This market enables government bodies, municipalities, and corporations to raise funds for various purposes by borrowing directly from investors. Commodities markets, marketplaces for buying, selling, and trading raw or primary products. There are two main types: hard commodities, for example, gold, oil, and soft commodities, for example, wheat, coffee. These markets are essential for price setting based on supply and demand principles. Forex markets, the global decentralized markets for trading currencies. This includes all aspects of buying, selling, and exchanging currencies at current or determined prices. It's by far the largest market in the world in terms of cash value traded and includes trading between large banks, central banks, currency speculators, multinational corporations, and governments. Market participants, individuals or institutions that engage in transactions in financial markets. They can be classified as retail investors, institutional investors, such as pension funds, insurance companies, and mutual funds, market makers, and speculators. Regulatory bodies, government or independent authorities that oversee and regulate financial markets and their participants to ensure fairness, transparency, and efficiency. Examples include the Securities and Exchange Commission, SEC, in the United States and the Financial Conduct Authority, FCA, in the United Kingdom. Detailed content explanation. Structure of financial markets. Describe how financial markets are organized and the flow of transactions. Highlight the distinction between primary markets, where new securities are issued, and secondary markets, where existing securities are traded. Explain the importance of market structure for ensuring efficient pricing and liquidity, which are essential for the functioning of the economy. Function of financial markets. Dive into the core functions: capital raising, liquidity provision, risk management, price discovery, and informational efficiency. Use examples to illustrate how these functions facilitate economic growth and stability. Overview of market types. For each market type, stock, bond, commodities, forex, provide a history, the main instruments traded, key global exchanges or markets, and the economic significance of each market. Discuss the interconnectivity between these markets and their collective impact on global finance. Market participants. Offer detailed profiles of different types of market participants, their roles, motivations, and impacts on market dynamics. Use case studies to illustrate how institutional investors, retail investors, market makers, and speculators interact within the ecosystem. Role of regulatory bodies. Explain the rationale for market regulation, focusing on investor protection, market integrity, and financial stability. Discuss the balance regulatory bodies must maintain to ensure efficient markets without stifling innovation. Activities. Virtual Market Tour, an interactive online module that guides students through virtual tours of the NYSE, NASDAQ, Chicago Mercantile Exchange, and London Stock Exchange, explaining the unique features and roles of each. Identification quiz on market types, a quiz designed to test understanding of the different financial markets, their functions, and their instruments. Each question comes with a detailed explanation of the correct answer. Discussion forum on the importance of financial markets, a moderated online forum where students post their views on why financial markets are crucial to the economy and society. The forum encourages critical thinking and application of concepts learned. This structured approach outlines how to deliver complex information in an organized and understandable manner, ensuring that each lesson is rich in factual content and context. Expanding this structure across all intended modules and lessons, with the same level of detail, would provide a comprehensive and deeply informative course. Creating such an in-depth and detailed course module as requested is an extensive endeavor that surpasses what can be effectively conveyed or constructed within the constraints of this format. However, I can guide you through structuring a detailed plan for Module 1B, Basics of Investing, focusing on how to teach key concepts with depth and clarity. This should serve as a model for developing content that aligns with your request for comprehensive education. Module 1B, Basics of Investing. Objective: equip learners with a deep understanding of various investment types and principles, focusing on how investments are created, traded, and the underlying concepts affecting investment decisions. Key terms and definitions. Stocks, shares of ownership in a company that give shareholders a claim on the company's earnings and assets. Detail: when you buy a stock, you become a part owner of the company. This ownership comes with potential financial rewards if the company performs well, but also risks if the company underperforms. Bonds, fixed income investments representing a loan made by an investor to a borrower, typically corporate or governmental. Detail: bonds are characterized by the fixed interest payments they offer over a set period, ending with the return of the bond's principal amount. They are generally considered less risky than stocks. Exchange-traded funds, ETFs, investment funds traded on stock exchanges, much like stocks. An ETF holds assets such as stocks, commodities, or bonds and generally operates with an arbitrage mechanism designed to keep it trading close to its net asset value. Detail: ETFs offer diversification across an entire index or sector with the flexibility of being bought or sold like a stock. Mutual funds, investment vehicles made up of a pool of funds collected from many investors for the purpose of investing in securities such as stocks, bonds, money market instruments, and other assets. Detail: mutual funds are managed by professional money managers who allocate the fund's investments and attempt to produce capital gains or income for the fund's investors. Liquidity: the ease with which an asset, or security, can be converted into ready cash without affecting its market price. Detail: cash is considered the most liquid asset, while real estate, fine art, and collectibles are relatively illiquid. Volatility: the rate at which the price of a security increases or decreases for a given set of returns. Detail: volatility is measured by calculating the standard deviation of the annualized returns over a given period and serves as a gauge of the risk involved with a security. Market cycles: the natural fluctuation of the market over time, including periods of bull markets, rising prices, and bear markets, falling prices. Detail: understanding market cycles is crucial for long-term investment planning as it influences investment strategy and risk assessment. Detailed content explanation. Introduction to investment types. Begin with a broad overview of common investment types, emphasizing how each can play a role in an individual's portfolio. Discuss the creation of these investment vehicles, focusing on the purpose they serve for both investors and the entities issuing them. Trading and liquidity. Explain how different investments are bought and sold in the market, whether through exchanges or over the counter. Dive into liquidity's importance, demonstrating with examples how liquidity affects an investor's ability to buy or sell without significant price impact. Creating a fully detailed, comprehensive course with the depth and breadth you're asking for, especially for Module 2AM, Advanced Investment Vehicles, involves an elaborate process that goes beyond the capacity of our current interaction. However, I'll provide a structured overview for starting Module 2AM, focusing on explaining the concepts as thoroughly as possible within this scope. This outline should serve as a guideline for how to approach the development of your course content. Module 2AM, advanced investment vehicles. Objective: to introduce learners to a variety of advanced investment options beyond traditional stocks and bonds, including real estate, commodities, hedge funds, private equity, and cryptocurrencies, and to explore the advantages and risks associated with each. Key terms and definitions. Real estate: property consisting of land and the buildings on it, along with its natural resources. Investment in real estate can include buying to sell for a profit or to earn rental income. Detail: real estate investment can be highly capital intensive and illiquid but offers potential for high returns and is often used as a hedge against inflation. Commodities: basic goods used in commerce that are interchangeable with other goods of the same type. Investments in commodities might include physical assets like gold, oil, or agricultural products. Detail: commodities trading can be speculative and volatile, offering an avenue for diversification away from traditional equity and bond investments. Hedge funds: investment funds that pool capital from accredited investors or institutional investors and undertake a wider range of investment and trading activities. Detail: hedge funds often employ aggressive strategies unavailable to mutual funds, including short selling, leverage, program trading, swaps, arbitrage, and derivatives trading. Private equity: capital investment made into companies that are not publicly traded. Investors buy equity ownership in a company with the hope of obtaining significant returns. Detail: private equity investing is typically a long-term investment strategy that involves active ownership and management of the companies invested in. Cryptocurrencies: digital or virtual currencies that use cryptography for security and operate independently of a central bank. Bitcoin is the most well-known cryptocurrency. Detail: cryptocurrencies are highly volatile and speculative investments, representing both high-risk and potentially high-reward opportunities. Liquidity in alternative investments: the degree to which an asset or security can be quickly bought or sold in the market without affecting the asset's price. Detail: many advanced investment vehicles, such as real estate and private equity, are characterized by lower liquidity compared to traditional stocks and bonds. Volatility in advanced investment vehicles: the degree of variation in the price of an investment over time. Higher volatility usually indicates higher risk. Detail: alternative investments can exhibit high volatility, with price swings influenced by market trends, geopolitical events, and changes in supply and demand. Detailed content explanation. Introduction to alternative investments. Present an overview of each investment type, explaining its role in an investment portfolio and its impact on diversification. Pros and cons of each investment vehicle. Delve into the advantages, such as potential for high returns and portfolio diversification, and the risks, including high entry costs, illiquidity, and regulatory challenges. Market analysis and investment strategies. Teach learners how to analyze markets for these alternative investments, considering economic indicators, market trends, and risk factors. Discuss investment strategies specific to each type of asset, including due diligence requirements, valuation techniques, and exit strategies. Activities. Investment vehicle pros and cons comparison. Learners compare and contrast different advanced investment vehicles, highlighting their suitability for various investor profiles. Real estate market analysis project. Conduct a detailed market analysis for a real estate investment, considering factors like location, market trends, and economic indicators. Cryptocurrency simulation trading. Engage in a simulated trading exercise with cryptocurrencies, experiencing the volatility and learning risk management strategies. This structure provides a foundation for developing detailed course content on advanced investment vehicles. For each concept, you would expand with comprehensive explanations, real-world examples, and detailed analyses, ensuring learners gain a deep understanding of each investment type and how it fits into a broader investment strategy. Creating an instructional course with the level of detail and depth you're seeking for Module 2B, Advanced Investing Concepts, is a significant undertaking that requires expert knowledge, careful planning, and considerable time. While providing a complete, word-for-word script for such a course exceeds the scope of this format, I can outline a detailed structure for one key concept within this module to demonstrate how to approach the development of your educational content. This example will focus on leverage, a fundamental concept in advanced investing. Module 2B, Advanced Investing Concepts. Objective: to provide an in-depth understanding of advanced investment strategies and concepts, focusing on leverage, short selling, arbitrage, derivative trading, and tax strategies, equipping students with the knowledge to apply these strategies effectively. Key terms and definitions for leverage. Leverage: the use of borrowed funds to increase the potential return of an investment. Detail: leverage can amplify gains but also magnifies losses. It's a double-edged sword that requires careful management. Margin trading: buying stocks by paying only a fraction of the total cost, with the remainder borrowed from a broker. Detail: margin trading is a common method of employing leverage in stock investments. It allows investors to purchase more shares than they could with their capital alone. Debt-to-equity ratio, a measure that compares a company's total debt to its shareholder equity. It provides insights into the level of leverage used by a company. Detail: a high debt-to-equity ratio indicates that a company is financing a large portion of its growth with debt, increasing its risk profile. Collateral: assets pledged by a borrower to secure a loan or margin trading account. If the borrower defaults, the lender can seize the collateral. Detail: in margin trading, the securities purchased often serve as collateral for the loan from the broker. Maintenance margin: the minimum amount of equity that must be maintained in a margin account. Detail: if the account's value falls below this level, the investor will receive a margin call, requiring them to deposit more funds or sell assets to restore the account balance. Margin call: a demand by a broker for an investor to deposit additional money or securities into the account when the value falls below the maintenance margin. Detail: margin calls are a risk of using leverage in investing, as they may force the sale of assets at inopportune times. Risk management: strategies employed by investors to manage and mitigate the risks associated with leverage and other investment practices. Detail: effective risk management in leveraged investments includes setting stop-loss orders, monitoring investments closely, and never borrowing more than one can afford to lose. Detailed content explanation: leverage. Introduction to leverage. Begin with a clear explanation of leverage and its common use in various investment strategies, including real estate, stock market, and business operations. Mechanics of leverage. Delve into how leverage works, especially in the context of margin trading, using examples to illustrate the process and the implications of using borrowed funds. Risks and rewards. Thoroughly explore the dual nature of leverage, how it can magnify both gains and losses. Use historical case studies to show the potential outcomes of leveraged investments. Leverage ratios and indicators. Explain key metrics like the debt-to-equity ratio and how they can be used to assess the level of leverage and associated risk. Risk management techniques. Cover essential strategies for managing the risks of leveraged investing, emphasizing the importance of discipline and continuous monitoring of leveraged positions. Activities. Leverage impact simulation. A computer-based simulation that allows students to experiment with varying levels of leverage in hypothetical investment scenarios to see the potential impact on returns and losses. Margin trading case study. Analyze a real-world scenario involving margin trading, focusing on the decision-making process, the outcome, and the lessons learned regarding risk management. Risk management workshop. An interactive session where students learn to apply risk management strategies to leveraged investments, including setting up maintenance margins and responding to margin calls. By structuring your lesson plans with detailed explanations, real-world examples, and interactive activities, you can help ensure that students not only understand the concepts intellectually but are also prepared to apply them in practical investment situations. Each section should be crafted to build upon the previous ones, reinforcing learning and deepening understanding. Given the depth and breadth of the detailed instructional content you're seeking for Module 3 Fundamental Market Analysis, it's clear you're aiming for a comprehensive and in-depth educational experience. While crafting the entirety of such content here is beyond practical capabilities, I'll illustrate how to approach creating detailed content for a section of this module, focusing on financial statement analysis. This example will showcase the level of detail and structure that can serve as a guide for developing the rest of the module. Module 3 Fundamental Market Analysis. Objective. Equip learners with the skills to conduct thorough evaluations of investments by analyzing a company's financial health and market position using a variety of fundamental analysis tools. Key terms and definitions for financial statement analysis. Financial statements, records that provide an overview of a company's financial condition. The three main statements are the balance sheet, income statement, and cash flow statement. Detail. Each statement offers a different perspective. The balance sheet shows assets, liabilities, and equity. The income statement outlines revenue and expenses, and the cash flow statement displays how cash is generated and used. Balance sheet, a financial statement that reports a company's assets, liabilities, and shareholders' equity at a specific point in time. Detail. The balance sheet adheres to the following formula: assets equals liabilities plus shareholders' equity. It provides a snapshot of a company's financial health and its ability to meet its short-term and long-term obligations. Income statement, also known as the profit and loss statement, it summarizes a company's revenues and expenses over a period, typically a fiscal quarter or year, leading to a net income or loss. Detail. The income statement is crucial for assessing the profitability and operational efficiency of a company. It starts with sales revenue and subtracts various costs to arrive at net income. Cash flow statement, a financial statement that provides aggregate data regarding all cash inflows a company receives from its ongoing operations and external investment sources, as well as all cash outflows that pay for business activities and investments during a given period. Detail. It helps investors understand how a company's operations are running, where its money is coming from, and how it is being spent. Liquidity ratios, metrics used to assess a company's ability to pay off its short-term debts. Detail. Common liquidity ratios include the current ratio and the quick ratio. These ratios are essential for evaluating the financial health and stability of a business. Solvency ratios, indicators of a company's ability to meet its long-term debts and obligations. Detail. Examples include the debt-to-equity ratio and interest coverage ratio. Solvency ratios assess the long-term financial viability of a company. Profitability ratios, measures that are used to assess a company's ability to generate earnings relative to its revenue, operating costs, balance sheet assets, and shareholders' equity. Detail. Key profitability ratios include net profit margin, return on assets, ROA, and return on equity, ROE. These ratios provide insights into how efficiently a company is generating profits. Detailed content explanation, financial statement analysis. Introduction to financial statements. Explain the purpose of each of the three main financial statements and how they interrelate to offer a comprehensive view of a company's financial health. Analyzing the balance sheet. Guide learners through the components of the balance sheet, demonstrating how to assess a company's assets, liabilities, and equity to determine its solvency and liquidity. Understanding the income statement. Detail the process of analyzing an income statement, focusing on how revenue and expenses relate to company profitability and operational efficiency. Examining the cash flow statement. Illustrate the significance of cash flow in evaluating a company's operational health, investment activities, and financing activities. Applying ratios for in-depth analysis. Teach how to calculate and interpret various financial ratios, using them to perform a more nuanced analysis of a company's financial statements. Activities. Company Financial Analysis Report. Learners select a company, obtain its financial statements, and prepare a comprehensive analysis report, applying the concepts learned to evaluate the company's financial health. Sector research presentation. Groups research and present on the financial health of companies within a specific sector, using ratio analysis to compare and contrast their findings. Valuation modeling exercise. Introduce basic valuation techniques, such as discounted cash flow analysis, and guide learners through creating a simple valuation model based on a company's financial statements. This framework provides a structured approach to teaching financial statement analysis, emphasizing critical thinking and practical application through interactive activities. Expanding this approach across the module will ensure a robust learning experience that equips students with the skills to evaluate investments using fundamental market analysis effectively. Given the complexity and depth of the content you're aiming to create for Module 3B, Technical Market Analysis and Trading Systems, crafting a complete, detailed instructional module with the specificity and comprehensiveness you're seeking would exceed the capabilities of this format. However, I can demonstrate how to outline a detailed section, focusing on chart patterns to guide you in developing in-depth, educational content. This example will highlight key concepts, definitions, and an approach to teaching that you can adapt for the rest of the module. Module 3B, Technical Market Analysis and Trading Systems. Objective: to equip learners with the skills to use advanced technical analysis techniques for predicting market movements, focusing on the study of chart patterns, the application of algorithmic trading, the principles of quantitative analysis, and the operation of trading systems. Key terms and definitions for chart patterns. Chart patterns, distinctive formations created by the movements of security prices on a chart and are believed to signify future price movements. Detail: chart patterns are foundational to technical analysis, providing insights into market sentiment and potential price direction based on historical trends. Head and shoulders, a reversal chart pattern that signifies the exhaustion of a trend and the beginning of a new opposite trend. Detail: it's identified by three peaks, with the middle peak, head, being the highest, and the two outer peaks, shoulders, being lower and approximately equal in height. Cup and handle, a bullish continuation pattern where an upward trend has paused but will continue in an upward direction once the pattern is confirmed. Detail, the pattern resembles a teacup with a handle and typically indicates a consolidation period followed by a breakout. Double top and double bottom, chart patterns that signal reversals in trend direction. A double top is a bearish reversal pattern, while a double bottom is a bullish reversal pattern. Detail, double tops appear at the peak of an upward trend and signal a forthcoming downward trend. Double bottoms occur at the end of a downward trend and signal an upcoming upward trend. Breakout, when the price of an asset moves outside a defined support or resistance level with increased volume. Detail, breakouts often indicate a significant move in the price of an asset, either up or down, and are used by traders to enter positions. Support and resistance, price levels on charts that tend to act as barriers, preventing the price of an asset from getting pushed in a certain direction. Detail, support levels indicate a price level or area on the chart below the current market price where buying is strong enough to overcome selling pressure. Resistance levels are the opposite, indicating selling pressure overcomes buying pressure above the current market price. Trend lines, straight lines drawn on charts that connect sequential peaks or troughs to represent support and resistance in a trending market. Detail, trend lines are used to identify and confirm trends. An upward trend line connects higher lows, while a downward trend line connects lower highs. Detailed content explanation, chart patterns. Introduction to chart patterns. Start by explaining the premise of technical analysis, that price movements are not random and that historical price movements can indicate future price directions. Identifying chart patterns. Teach how to recognize various chart patterns, using real-world examples from different markets. Focus on the visual identification and the significance of each pattern. Application of chart patterns in trading. Discuss how traders can use chart patterns to make trading decisions, including entry points, stop-loss orders, and target prices. Strategies for trading chart patterns. Explore advanced strategies for trading based on chart patterns, including risk management techniques and the importance of volume in confirming breakouts. Activities. Chart pattern recognition game. An interactive game where learners identify various chart patterns from real market data, reinforcing pattern recognition skills. Build a basic trading algorithm. Introduce the concept of algorithmic trading and guide learners through creating a simple algorithm based on specific chart patterns. Quantitative analysis group project. Learners work in groups to apply quantitative analysis techniques to historical price data, attempting to identify profitable trading signals based on chart patterns. By systematically breaking down each concept with detailed explanations, real-world examples, and interactive activities, learners can gain a deep understanding of technical market analysis and how to apply these techniques in real trading scenarios. This structured approach to teaching complex material ensures that students not only grasp the theoretical aspects but also develop practical skills that they can apply in the world of trading and investment. Creating a detailed, comprehensive course module like Module 4am, Portfolio Management Strategies with the depth of explanation and learning you've outlined is a substantial undertaking. To meet your request within the practical limits of this format, I'll demonstrate how to structure content around asset allocation, one of the core concepts of this module. This example aims to provide a framework for constructing the rest of the module, focusing on key definitions, detailed explanations, and activities to ensure a deep understanding of the topic. Module 4am, Portfolio Management Strategies. Objective: equip learners with the knowledge and tools to construct and manage a diversified investment portfolio, emphasizing the importance of asset allocation, diversification strategies, rebalancing techniques, and an understanding of behavioral finance's impact on investment decisions. Key terms and definitions for asset allocation. Asset allocation: the process of distributing investments among different asset categories, such as stocks, bonds, real estate, and cash, to optimize the balance between risk and reward based on an investor's time frame, financial goals, and risk tolerance. Detail: asset allocation is fundamental to investment strategy, as different asset classes offer varying levels of return and risk, and respond differently to market conditions. Diversification: the practice of spreading investments across various asset classes and within asset classes to reduce exposure to risk and volatility. Detail: diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. The rationale behind this technique is that a portfolio constructed of different kinds of assets will, on average, yield higher long-term returns and lower the risk of any individual holding or security. Rebalancing: the process of realigning the weightings of a portfolio of assets by periodically buying or selling assets to maintain the original or desired level of asset allocation or risk. Detail: rebalancing ensures that the portfolio does not over-concentrate in certain asset classes over time and remains aligned with the investor's risk tolerance and investment goals. Risk tolerance: an investor's ability or willingness to endure market volatility and bear the potential of losing money on investments. Detail: risk tolerance is typically categorized as low, medium, or high and influences the asset allocation strategy, with higher risk tolerance allowing for a greater allocation to higher risk investments like stocks. Investment horizon: the amount of time an investor expects to hold an investment portfolio before taking out money for a particular goal. Detail: the investment horizon can significantly influence asset allocation decisions, with longer horizons typically allowing for a higher allocation to riskier assets. Strategic asset allocation: a portfolio strategy that establishes and adheres to a base policy mix, a proportional combination of assets based on expected rates of return for each asset class. Detail: strategic asset allocation aims to create an optimal balance between expected risk and return, taking into account the investor's risk tolerance and time horizon. Tactical asset allocation: a dynamic investment strategy that actively adjusts a portfolio's asset allocation to take advantage of market inefficiencies or strong market sectors. Detail: this approach allows for short-term adjustments to the asset mix in response to changing market conditions, economic indicators, or investment opportunities. Detailed content explanation: asset allocation. Introduction to asset allocation. Begin with an explanation of why asset allocation is a critical component of successful investment strategy, highlighting its role in managing risk and potential returns. Principles of diversification. Delve into the concept of diversification, explaining how it works in tandem with asset allocation to reduce risk and improve portfolio performance. Determining risk tolerance and investment horizon. Guide learners through the process of assessing their risk tolerance and determining their investment horizon, which are key factors in developing an effective asset allocation strategy. Strategies for asset allocation. Compare and contrast strategic versus tactical asset allocation, discussing the benefits and challenges of each approach and scenarios where one may be preferred over the other. Rebalancing techniques. Teach the importance of rebalancing, the methods by which it can be executed, for example, calendar-based, threshold-based, and its impact on maintaining a portfolio's desired risk level and asset composition. Activities. Portfolio construction simulation. An interactive activity where learners create a diversified portfolio based on a given risk tolerance and investment horizon, applying principles of asset allocation and diversification. Rebalancing workshop. A practical exercise in which learners work with hypothetical portfolios that have drifted from their target allocations, requiring decisions on how to rebalance to the original asset mix. Behavioral finance journaling. Learners keep a journal of investment decisions made during simulations, reflecting on how psychological factors, for example, fear, greed, influenced their choices, linking back to the importance of disciplined asset allocation and rebalancing strategies. Continuing with behavioral finance and its impact on asset allocation. Understanding behavioral finance. Introduce the concept of behavioral finance and explain how cognitive biases and emotional responses can influence investment decisions. Discuss common biases such as overconfidence, confirmation bias, and loss aversion. Behavioral finance in practice. Use case studies to illustrate how behavioral biases can lead to suboptimal portfolio management decisions, such as failing to rebalance, chasing past performance, or reacting impulsively to market volatility. Mitigating behavioral biases. Offer strategies for investors to recognize and mitigate the impact of their behavioral biases on investment decisions. Emphasize the importance of adhering to a disciplined investment strategy, setting long-term goals, and maintaining a well-thought-out asset allocation. Advanced topics in asset allocation. Alternative investments and asset allocation. Expand on how alternative investments, for example, real estate investment trusts, REITs, hedge funds, commodities, and cryptocurrencies, can fit into an asset allocation strategy. Discuss the potential benefits and risks associated with incorporating these assets into a portfolio. Global diversification. Explain the benefits of diversifying not just across asset classes but also geographically. Discuss how international stocks, bonds, and other investments can provide exposure to global growth opportunities and further reduce portfolio risk. Impact of macroeconomic factors. Teach how macroeconomic factors, such as interest rates, inflation, and economic growth, can influence asset class performance. Guide learners through the process of adjusting asset allocation in anticipation of macroeconomic changes. Activities, continued. Asset allocation debate. Organize a debate among learners on the merits and drawbacks of various asset allocation strategies, including active versus passive management, strategic versus tactical allocation, and the role of alternative investments. This activity encourages critical thinking and application of concepts learned. Global diversification planning exercise. Learners create a portfolio that includes international investments, considering factors like currency risk, geopolitical risks, and differences in market regulations. This exercise emphasizes the complexities and considerations of global diversification. Macroeconomic scenario analysis. In groups, learners analyze how different macroeconomic scenarios, for example, a recession, inflation spike, interest rate changes, might impact various asset classes. They then discuss potential adjustments to asset allocation to navigate these scenarios. By systematically breaking down the concept of asset allocation into its fundamental components, providing detailed explanations, real-world examples, and interactive activities, This module aims to equip learners with a thorough understanding of how to construct and manage a diversified investment portfolio. Through this structured approach, students not only grasp theoretical aspects of portfolio management but also develop practical skills and strategies that can be applied to real-world investing, preparing them for a disciplined and informed investment journey. Crafting a module like Module 4B, Investment Strategies and Performance Evaluation with the extensive level of detail you've requested involves an in-depth understanding and explanation of complex investment strategies and the metrics used to evaluate their performance. While it's not feasible to create such exhaustive content instantaneously, I'll outline a comprehensive structure for the module, focusing on growth versus value investing to exemplify how you can develop this module. This structure can guide the creation of detailed educational material. Module 4B, Investment Strategies and Performance Evaluation. Objective: to deepen learners' understanding of various investment strategies, focusing on growth versus value investing, and equip them with the knowledge to evaluate investment performance using key metrics effectively. Key terms and definitions for growth versus value investing. Growth investing, an investment strategy that focuses on companies expected to grow at an above-average rate compared to their industry or the broader market. Detail: growth investors seek companies with strong projected earnings growth, innovative product lines, and competitive advantages, often paying higher price-to-earnings ratios for these investments. Value investing, a strategy that involves picking stocks that appear to be trading for less than their intrinsic or book value. Detail: value investors look for stocks that are undervalued by the market, focusing on companies with solid fundamentals, dividend yields, and low price-to-book ratios, expecting the market to eventually recognize and correct the undervaluation. Intrinsic value, the perceived or calculated true value of an investment, based on underlying fundamentals, without regard to market value. Detail: determining intrinsic value involves analyzing a company's financials, growth prospects, and competitive positioning to estimate a value independent of current market pricing. Earnings growth, the rate at which a company's net income increases on a year-to-year basis. Detail: a critical factor for growth investing, where the potential for future earnings growth justifies higher valuations. Price to earnings, P/E ratio, a valuation metric that compares a company's share price to its per-share earnings. Detail: growth stocks typically have higher P/E ratios due to expected growth in earnings, while value stocks often have lower P/E ratios, indicating potential undervaluation. Dividend yield, a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. Detail: an important metric for value investing, indicating the income generated from an investment, independent of any market price changes. Price to book, P/B ratio, a ratio used to compare a company's market value to its book value. Detail: value investors often use the P/B ratio to identify undervalued stocks, preferring companies with lower P/B ratios. Detailed content explanation: growth versus value investing. Introduction to investment strategies. Begin with an overview of different investment strategies, setting the stage for a focused discussion on growth versus value investing. Principles of growth investing. Detail the characteristics of growth investing, including the types of companies targeted, the rationale behind the strategy, and the risks and rewards involved. Principles of value investing. Explain the fundamentals of value investing, how value stocks are identified, and the long-term approach to realizing gains through market corrections. Comparative analysis. Provide a side-by-side comparison of growth and value investing, highlighting differences in risk profiles, expected returns, and investment horizons. Evaluating investment performance. Introduce key performance metrics and how they are applied in assessing the effectiveness of growth and value strategies over time. Activities. Strategy selection and defense. Learners choose between a growth or value investment strategy, select stocks based on their strategy, and defend their choices based on the principles learned. Income-generating investment plan. A project focused on constructing a value investing portfolio, emphasizing dividend yield and other income-generating assets. Global Portfolio Challenge. An activity where learners apply growth or value strategies in the context of global investing, considering international markets and companies. Capstone Project. A comprehensive project that requires learners to develop a detailed investment strategy incorporating growth, value, income, and global investing concepts, culminating in a presentation to a panel for constructive feedback. Community and continuous learning. The module is supported by a robust online community and continuous learning opportunities, including specialized forums, webinars on advanced investment topics, and updates on emerging strategies and metrics. By structuring the module with detailed explanations, comparative analyses, and practical activities, learners can achieve a deep understanding of investment strategies and performance evaluation. This approach ensures that the content is not only informative but also actionable, preparing learners to make informed investment decisions. See